welcome to today's session. We're talking about USDA and other loans. Gina Cash is going to be our host today and share some great information, not only on USDA and regular loans, but also some, Gina, I don't know, how would you say it, just special programs?
Well, believe it or not, the best thing that I can do is just kind of go over what I call the first-time home buyer programs, because it hits pretty much everything and gives you some great information on all.
Awesome. Okay, so I am going to have you take it away.
Thank you so much. I'm going to do my share screen here. Okay, so we should be, everybody can see now?
We got it.
Wonderful. So first-time home buyers are kind of they're my babies. I love to work with first-time home buyers, mainly because they're so anxious, and part of my job is to kind of walk them through, make sure that they have what you need. All of these programs are going to apply to pretty much everybody, but they really are designated to kind of assist with those first-time home buyers. So first thing we want to do is we want to determine what their affordability is. We want to determine what their income is, what their debt is, how much they have for a down payment, if they have any at all. We need to know what their credit score is and where they're looking. Each area is going to have a different number that is considered appropriate. So FHA has a max limit in one county that might be different than the next county over. So we want to make sure that we get it within those confines. The first thing we do is we run their credit, make sure that we know where they are. One of the things that we provide as a service is we have an on-site, she's a credit analyst. And so once I review your credit and I can see what's going on, I can a lot of times get people up in their scores in 30 days. For instance, both mine and Amy's son had very similar needs when they went to go purchase a home. And my son had one score, and I think Amy's had either one score or no scores. So it was kind of important that we got them a score very quickly. They qualified in all other places. They just didn't have a good credit score. So we did what we needed to do. I gave Amy some direction on how to get her son a score quickly, and then I called my son when I did his and had him do the same thing. Amy's son walked in the door in about 10 days with an 801 FICO score, which was amazing for not having any credit prior. My son ended up in less than 30 days with a 760 FICO score. Neither one of them had negative credit. They both had great debt ratio was fine. They both had great income and they both had great longevity on their jobs. They just had never applied for a credit card. They were both paying cash for everything. So if there's any delinquent credit, that always has going to have to be paid off. And the main reason for that is if it's a collection and it's not a medical collection, it's got to be paid off. The primary reason, as I explained to my clients, is that we want to make sure that they're not going to put a lien, or a creditor isn't going to come after the house that they just bought and put a lien on it. We want to look for discrepancies, make sure everything is there. And then we want to make sure that they don't have more than one, maybe two lates in the last 12 months at the very most. When I get somebody into a new credit card, I usually tell them to open a small credit card. It can even be a secured card for a couple of $100. And then I only want them to spend $10 a month, literally. And then I want them to auto pay it and pay it automatically every single month. Put that card away and not use it for the emergencies that you really want credit cards for. And that really is what helps to get your credit way up where you want it to be. It's never too late to start saving. However, a lot of the loans don't really need a whole lot of savings. So you can get down payments in as low as 0%, actually, all the way up to maybe 5%. You want to save for not only your down payment, but your closing costs as well. Taxes, insurance, your attorney's going to be in there, your appraisal is going to be in there. That usually runs between 2 and 6% on that. We have, in our state, we have an amazing down payment assistance program run through our North Carolina Housing Finance Agency. For first-time home buyers, I can get them into a loan for almost zero money out of pocket. We have, and the loans that they have for the down payment assistance are usually what they call a soft second. So there's a short period of time when or when it's considered a loan. So if they move out of the house or they sell the house, they would pay the money back, but it's usually at 0% with no payments. And then if they stay for a certain period of time, anywhere from 5 to 15 years, depending on the state and the program, the loan is forgivable, and it starts to forgive in increments up until it's completely gone at whatever the time frame is that it's set up for. So for instance, in our state, a USDA loan is 0 down. And then our housing finance agency has the down payment assistance program at $15,000. So I take a 0 down USDA loan. I use $15,000 in closing costs. I usually have more than enough to cover their closing costs. So then what I do with the extra is I end up putting it in and doing a principal reduction. So let's say they had a $200,000 loan on USDA. They had $15,000. It cost $10,000 to close. They had $5,000 extra that they didn't need. I put that towards their principal reduction. They walk in the door without paying any money out of pocket with a $195,000 loan after all of that. So it works out beautifully. So wholesale is what our company does. There's 2 different kinds of loans. If you go through a wholesale, you're going through a third party. So brokers will work with other brokers. They'll also work with other companies. And then that broker will underwrite the fund, the loan, and then they send it over to the broker. And then the retails, which is what our company does, we're called a correspondent loan. We handle the loan in-house. We can actually close loans in as little as, legally, we can only close them in as little as 7 days. You have to have 3 days to get the first closing disclosure out, and then the loan estimate. And then there has to be a time period to send out the next, and then 3 days for the closing disclosure. We can actually close on day 7. So 3 and 3 plus the day in between, that's 7 days. So we work directly with those buyers, and we offer our products from our institution, but we also offer products from other institutions. So we're able to shop a whole lot of different loans for your clients. So we also, as a wholesaler, what we do is we close the loan where we are, and then we sell it afterwards. So that makes it the best possible for you. You're getting a super fast close. You're getting everything in-house. I can walk in and talk to an underwriter and get your stuff squared away. And then once we're done, we sell the loan on the wholesale market, have that money back for the next person. When you're working with a loan officer, it's not letting me hide, sorry. That loan officer is going to recommend products based on your scenario. Every single scenario is different. Let's ensure that you've got appropriate documents, and then we calculate what you can afford. Before you shop, you want to know what a pre-approval is and what a pre-qualification is, and then you'll want to know the documents that you need. There's a difference. I can give you a pre-qualification based on a conversation. Once I say I need to get you pre-approved, that means that I have reviewed all the documents that you've submitted or I've requested, and I've made sure that they've gone through. I've also gotten you an automated underwriting through our desktop underwriter, whether that's Fannie Mae or Freddie Mac, doesn't matter, or even USDA for that matter. So you have actually been automatically pre-approved. Then what we do, once we've gotten to there, we end up going to the underwriter after that. So even though it's pre-approved, legally, you're not approved until the check is signed. So typically the documents that you're going to need, it's pretty easy. 30 days of pay stubs, 2 years of W-2s. Normally, we don't ask for tax returns unless they're necessary. 2 months of bank statements. If you're self-employed, we usually need 2 years of your back business tax returns, and then the most recent profit and loss statement. So once you've got all of that done, you're ready to go shopping. That's when they're going to find a real estate agent. And then they want to interview them. We always recommend they interview and talk to them. And then we strongly recommend they sign a real estate contract. The real estate agent is paid by the seller at closing, not by the buyer. And so I've had buyers say, wait a minute, I didn't agree to pay them. And I said, you're not, you're good. And they're like, oh, I didn't know. So they saw the numbers on their closing statement and couldn't figure out why they were having to pay, even though they didn't realize it wasn't theirs. So you guys know what the real estate agent does. Once you're making an offer, your real estate agent is going to be your number one source. You guys will negotiate the offer. You'll make the type of offer, as you know, there's a full price below asking or over asking. You'll run the counter offers and you'll negotiate that entire thing. And then you've got the option to add concessions and what other items that you require into that loan. So your earnest money deposit. So in North Carolina, we actually have two different kinds of deposits. We have an earnest money and then we have a due diligence. Every state is different. We've learned that just because North and South Carolina are literally across. I live 2 miles from South Carolina, and in South Carolina, they just put the due diligence in. They only had earnest money prior. So you want to make sure that you know what your state does and how those affect your loan. For instance, a due diligence, once you've released that money, it goes in almost immediately. And even if you pull out for reasons that have to do with the house itself, you don't get that money back. That money goes right to that seller. And then the earnest money is usually held in escrow, and that money is part of your down payment. They're actually both part of your deposit and down payment. They're utilized towards your loan. If you walk away, that they usually still get to keep that due diligence. Earnest money, that would be negotiable depending on when your due diligence term is up and if you've asked for it to cancel prior to that or not. So inspections are paid for directly by the buyer. Usually once you have them done, so you always want to be ready for that. Most of your closing costs estimates will not have any inspections in them because nobody knows what inspections the seller or the buyer is going to request. Any repairs that are going to be needed usually will be negotiated again by that real estate agent, their number one person, the person that's leading the team to get everything there. And then a lot of those repairs may possibly be directed by the type of loan you have. So for instance, VA, USDA, and FHA require that all systems, all security, and all safety items have been reconciled. So you want to make sure that you don't have like a loose handrail, or you have a handrail where there's more than 3 steps going down. All the fire things are in the bedrooms where they're supposed to be so that you have those. We also usually your loan is put in, or your offer is put in with the contingency, and the contingency is based on how far or how fast you can get prior to that. You also might have a contingency for maybe a home that you need to sell prior to close. So a contingency just means that it has to happen before you can finish. The loan application is a pretty cool thing. Most of this is done online now. It's a rare moment when I actually get to meet my clients anymore. Everything is done so quickly. But here's just like kind of an idea of all the things that we look for. We look for your type of credit that you're asking for, your social security number, your date of birth, your legal name. Legal name is really important. That's also a super important thing for you realtors. You need to ask them when you're writing the offer, who is going on that loan? Because if you put it as John and Jane Doe, and only John is on the loan, then you're going to have to turn around and correct your offer and remove Jane off of that offer. Now, the cool thing is that Jane can go on title, even though she's not on the loan. As long as they're married, or as long as their agreement, she can go on title, no problem. But she has to be on that loan application in order to be on the offer. The offer and the loan application, you want to match 100%. So current residents, usually we ask for 2 years of information on their residence and on their jobs. So as long as we have 2 years worth of information, even if that 2 years was school and they weren't actually making any money, or they were off work for a short period of time, but they can show that they had longevity prior to that, that's okay. We just have to usually have just a letter of explanations explaining that. But they usually want at least 2 years of just showing that you have had work experience.
Gina, quick question.
Yes.
When you were talking about they have to be on the loan application and the offer, but they don't necessarily, they can go on the deed and not be on the loan application. Is that every state?
True. Yes. Yeah, every state is that way. You want to make sure that if they're on that loan application, or usually you have the loan application before you have the offer. So you want that offer to meet that loan application. Now, in both North and South Carolina, I'm licensed in 5 states. Florida is the same way. Virginia is the same. I can put anybody on title, but I cannot remove somebody from title without a signature. Well, actually, you need a signature for all of that. So let's say that the loan is in John Doe's name, and John and Jane go on the title, and John passes away. Jane is now on the title, but there is no John. If she changes that title, what's going to happen is it's going to accelerate the clause on the mortgage. And if she changes it and changes it to just her name and takes John off, then the acceleration clause kicks in and that mortgage is now due and payable immediately. So I always recommend that if they are on the title but not on the mortgage and something happens, they talk to their lender that did the loan prior to doing anything. Do not change that title until you know it's okay. John has to be on that title in order to make sure that you don't have the acceleration clause. Now, if she's going to do a refinance and take over the house, that's totally fine. But you don't want the acceleration clause to be kicked before you're ready to take over. Does that help?
Yes, thanks.
Thank you. So home value, loan amount, and equity. We all know what that is. Your home value is going to be typically with the average loan. A conventional loan is usually an 80% to 20% loan amount versus equity. The best way, that's going to where you're going to get your very best rates. You don't have any mortgage insurance premium. The home value is going to be 100% of the loan amount and the equity together. So different kinds of loans. These are only three of the multiples. Conventional, FHA, and VA. Conventional is typically people that have the very best interest rate or the very best, usually a 680 and above score. They usually come in with at least 10 to 20% down. They can get away with 5. If we're doing a home ready or a home advantage loan, they can actually come in at 3%. Now, those are a great program as for a first-time home buyer offered by Fannie Mae and Freddie Mac. They will allow a first-time home buyer to come in with a 3% down. However, their income has to be at 80% or less of the average of that county. So if they don't value or they're not valued or they don't have a lot of income, they may qualify easily. Whereas if their income is a little bit higher, they would probably not qualify for that. So I usually look at that and make sure that people know that I can get them a 3% loan, but they have to have lower income. If they've got the lower income and they qualify, it's beautiful. If I have that kind of a loan, I'm probably going to go FHA because if they've got lower income, chances are really good that they're going to have a lower score as well. Scores for your FHA and VA, we can actually get you a loan on an FHA loan all the way down to 500. It's not affordable. I don't recommend it. Scary, but we can do it. If somebody's got a lot of money and they need a house right now and they've got a 510 score, I can get them a loan. It's just not going to be nearly as affordable as somebody that has a 580 or above, or really the best score to get is a 620 and above. So 620 and above, and I can pretty much do anything. Same thing with VA. VA has the ability to go down to 500 if necessary, but a lot of times it's going to be a lot more costly. It's going to be costly not only in your points, which means your money out of pocket right there, but also in your interest rate, which means you're going to be paying over the term of the loan of 360 months as well. Interest rates are also going to vary, again, based on what your level is of your debt ratio, of your FICO score, and of the amount of money that you're borrowing. So for instance, if you're borrowing more than, you're only borrowing 75% of the home, usually you're going to get a much better interest rate than you would at 80% or 10% or 90% or 95%. Two different kinds of loans that are pretty readily is your fixed rate loan and your adjustable rate loan. Adjustable rate, fixed rates are 360 months or 180 months or whatever the term of that loan is, and they never change. It's always going to be the same as far as the principal and interest. What can change are your taxes and your insurance, which the lender has no control over. Adjustable rate mortgages are based on a couple of different things. You might have a 5-1 arm, a 3-1 arm, which will adjust at each interval. It'll allow you to adjust at certain intervals, and that's part of the beauty of those. Honestly, right now, even with the rates being as high as they are compared to what they have been, the adjustable rates still aren't very affordable, and I'm still recommending fixed rates on almost everybody. So underwriting is once we have got everything into the underwriter, we have gotten the documents in. We usually have what we call a first pass at underwriting within 24 hours of having documents in. That means that you're going to have a conditional approval almost within 24 hours of you putting everything in, and you're going to know what you need to finish with, and that could take a couple of weeks to get through. A appraisal will be some of the things. Any potential repairs that need to be done, that'll be there. You want to make sure that all of those things are in place too, which your lender will help with. Usually the lender will open up title or order your title and open up escrow for you. I'll also order the appraisal almost immediately. I usually grab, once I get my completed contract, very first thing I do is I lock the loan. The very second thing I do is order appraisal. And so it's really important to me that I know that the things that are going to make a difference, whether that loan is going to go forward or not, are done immediately. The kind of property that you're going to trying to buy is going to impact everything. Condos usually have higher interest rates. Townhomes and single families usually are close. They're not much different. Manufactured homes, as long as they are on a permanent foundation, can be done with any of the Fannie Mae and Freddie Mac loans. Most of the programs require that they have at least a 660 score or higher. We can even do single wides now, as long as they're on those individual brick permanent foundations. Do you do a lot of those, Carrie? Of the manufactureds? So we're near the beach. We have a lot of manufactureds out here, and but they just have to be on that permanent brick foundation to be considered a real property. One of the other things that happens with those is that the title has to be canceled with the DMV, and then they also have to have gone down to the recording office and recorded it as real property. So that's called an affidavit of a fixation and cancellation of the title. So what you're trying to buy is going to make a difference. Are you trying to buy a lot and then add a property to it? Are you trying to buy something that's a flip? Are you trying to buy a reno loan or something that needs to be renovated before it's going to close fully? All of these things are going to make a difference in what your loan is going to look like. And they're all available. You just have to decide what is going to work for them. Assets. The assets are how much money you have in an account. They don't always have to be liquid. You might have IRA or retirement assets that aren't liquid, but you also want to use those in case you need those to buffer your loan. A lot of times the clients or the underwriter will ask for 3 months or 6 months of reserves, making sure that you've got enough money in the bank to cover whatever time period of those things. So you want to make sure that you're using, I don't usually use all of their assets if they've got a lot, but I'll use enough just to cover what they have to have for closing, and then a little bit extra for that buffer. And then credit. Credit is a huge thing when it comes to this. What have you shown that you're being able to pay your credit? And just by having that little credit card and barely using it shows that you're being responsible with your credit, and it makes a big difference on how you're going to qualify or not. Appraisal processes that determine the value. It's based on the details of that home and only that home. It's not based on the one next door or the one across the street. The details on that home are specific to your appraisal and what the current market is. I've gotten appraisal in the same day. I've actually had an appraisal I ordered on Monday. They went out on Monday afternoon and I got the report on Tuesday on a VA loan, no less. I've also had one that came in 45 days after we ordered it. So it can take a lot of time just depending on what's going on with your market. You also want to talk to your lender about that and make sure that they know what the time frame is and what the lead time is so that they're aware, because that's a big piece of your moving parts. If that appraisal doesn't come in, that client may decide that they don't want the house, or maybe they want it and they're going to negotiate again, or maybe they're going to take it and just keep that over amount. They don't care, but some people do care a lot. And so it's really important that that lender is on it and doing it right away. The lender is going to determine if the purchase price is supported. So sometimes we'll get an appraisal in, and then we'll get a notification asking for a desk appraisal on top of that. So sometimes they just want to double check that appraisal and make sure that it's actually being supported. If your purchase price is higher than the appraised value, you have options. You can negotiate. You can also negotiate it back down. I had one client that negotiated in the middle. And then some people don't care and they just want that house and that house only, they'll pay the extra value. Or you can cancel completely and walk away. So you do have options if that happens. Clear to close is the famous last words of any lender. This is the 3 words you want to hear from us. It typically takes about 30, maybe 45 days, depending on the program that you're using. Usually your closing agent will prepare all the closing documents, and they're usually done 2 to 3 days in advance. The closing date is going to impact your final costs because we have to pay prorated items for your taxes, for your interest, for your insurance. Those items are going to make a difference. So you want to make sure that you're working with your loan originator during this time, and that's something that's important. If that client doesn't have a whole lot of money in their pocket, they may want to push their close to the very end of the month, so they only have to pay a couple of days of interest and insurance and taxes. Others might want, I need to get in on the 1st because I've got to get out of my other house by the 5th. So that's also important. So you want to look at all those things when you're talking and when you're making that offer. Closing day is everybody's favorite. We actually do hybrid closings. So you'll get your documents at midnight the night prior, and you can actually take the time to review those and sign them at home. And then once you actually get to your closing, you're only there for about 30 minutes. There's only about 8 different signatures that are required. Most of the loan lenders are doing this now. However, if there is a power of attorney and one person isn't there, or the client is not computer savvy and they don't want to do that, you can still get everything done the traditional way and go in and sign everything. It says it can take 1 to 6 hours. Usually the longest I think I've seen is maybe an hour, hour and a half. Typically, depending on your state and your requirements, you may or may not get your keys. In our state, you're not allowed to give the keys out until it's recorded. Usually they're recorded the same day. Sometimes they go the following day. You just have to talk to your escrow officer, whether that's an attorney or an actual escrow agent, and make sure that you know what's going on so that you can get that information over. I strongly recommend that people don't schedule to move in the same day that they've closed, because there's, as we all know, there's going to be a potential hold up, and they may be sitting in a hotel for an extra day or two waiting for something to record. So you always want to have your clients ready for that. Typically, who's going to be at that closing? The seller may or may not be there. Usually they come in a day or so earlier here in this particular area. Real estate agents will usually come and show up. Your closing agents may or may not attend, as far as your lenders, but the attorney or the escrow officers will be there to walk you through everything. Everybody has to sign the documents. If you're on the document, you have to sign it. You have to have your ID so that we can confirm that you are who you say you are. And then anything that needs to be notarized, there will be a notary there to verify all those signatures. You always want to have that government ID, and then you want to make sure that your funds to close have been either wired prior to there, or you want to make sure that you have a cashier's check. We can't use cash, and we can't use a personal check at that point. Depending on the attorney, and you always want to check in advance, they have different requirements. Some will require that it is a cashier's check up to $500. Some are $5,000. Others are like, I want no cashier's check. I want you to wire everything, and that's that. That's all we accept. So you need to make sure that you know what the requirements are of your specific escrow office or attorney, so that you can make sure that your client is ready for those. When you walk out, you're going to have all of your documents, copies of everything. You're going to have information on where your first payment is going to be made, and it can change shortly thereafter. My first payment actually went to my servicer, and I never made a payment to my loan company because we had already sold it and it was long gone. So any tax forms that you may need to take to your city or county, usually your closer is going to do this, but in some states you have to take it yourself. And then possibly you might walk out with your keys on a good day, on a really good day.